Hey guys, what's going on? Welcome into the video. So in this one, we're going to be going over what to expect from a massive week of upcoming earnings reports up ahead. Next, we'll be talking about my personal opinion on when this stock market can finally find a bottom. And then finally, we're going to be talking about a big upcoming trade opportunity that will present itself soon. Alright, so first off, getting into it, we have a huge week of upcoming earnings coming up this week. About 1/3 of the companies that make up the entire S&P 500 have their earnings reports, so there's a ton of importance on how these earnings call will go and what the major CEOs will say about the guidance they give in the economy moving forward. Last week we had two big earnings reports from Netflix and Tesla. As I'm sure everybody knows, Netflix reported absolutely abysmal numbers, which included a loss of subscribers for the quarter. This resulted in a drop of over 35%. On the other hand, Tesla reported blowout numbers, which included the expectation of 50% annual growth on a multi-year basis moving forward. You seriously could not ask for better results than Tesla gave, and after an initial 10% gain in the pre-market, Tesla stock sold back off and only closed the week up about 2%. Now these two reports and the stock price moves could really portray a dangerous earnings season ahead. Netflix reported bad numbers and dropped 35% plus, and Tesla reported great numbers and only went up a couple percent. This tells us that the market most likely isn't going to be forgiving this earnings season, and stocks can end up going down huge on earnings misses, and yet on earnings beats, stock prices may only end up with slight stock price gains, which is certainly a dangerous place to be in. And overall, this will be a crazy week of earnings reports, with most notable ones starting on Tuesday with UPS, Microsoft, Google, Visa, Enphase Energy, and Chipotle all reporting. On Wednesday, Boeing, Spotify, Meta/Facebook, PayPal, Ford, Qualcomm, Pinterest, and Teladoc all report. Those are the most notable ones in my opinion. And then on Thursday, Twitter, Caterpillar, MasterCard, McDonald's, Apple, Amazon, Roku, and Intel all report their numbers. So the most important thing this week is earnings from big tech. So beneath the surface, most growth in small cap companies are down about 50 to 80%, some even 90% plus. But yet the market leaders in Apple, Microsoft, Amazon, and Google are down very minimally. I think that these companies are in a very tough place this upcoming earnings season, and if they don't have blowout numbers like they all usually do, we could see some pretty large drops in these names, which makes for dangerous market conditions as they make up such a large portion of the total S&P and NASDAQ indexes. Take Apple, for example, a company that almost always has blowout numbers at earnings. Last quarter, they absolutely blew out numbers. They kind of saved the entire stock market for those who remember. In my opinion, this earnings season, if Apple reports numbers in line or below expectations, the stock is going to drop substantially. I personally think there's a decent chance for an earnings miss and tweeted this thread last week. So my reasons for thinking this is that there's very tough comparisons versus last year Q1 numbers, where there's a 5G super cycle with the iPhone, therefore boosting sales big time. This year there's not too much of a catalyst to boost iPhone sales. It was also a COVID beneficiary and likely got a lot of Mac and iPad sales out of the way. There's also quite a few headwinds with Ukraine and Russia, which usually make up about 1 to 3% of Apple sales, and also a much weaker Chinese economy, which usually makes up close to 20% of Apple sales, so that will certainly be affected in that sense. A lot of investors have piled into Apple as a safety name, and you could also say the same with Microsoft, Google, and Amazon, etc. If numbers don't impress, I do think we could see a quick 10 to 15% drop in Apple stock. A big reason for this is because the stock is still pretty expensive. It trades for a 28 price to earnings ratio with below 10% revenue growth moving forward. This earnings multiple could easily get re-rated to the low 20s in my opinion, which could be anywhere from a 10 to a mid 20% style drop. Now sure, I could easily be wrong on this prediction because after all, Apple is the top 3, if not the number 1 greatest company in the entire world. But I'm just saying that this fundamental setup is a dangerous place going into earnings for Apple. And based on technicals, if it was to break below this uptrend, it could get very ugly for the stock. You could say the same thing for the other mega cap tech stocks as well. Microsoft is hard to predict a miss on because the majority of the revenue is software subscription based. Very consistent revenue and earnings they seem to always beat, but the stock certainly doesn't trade cheap, and the technical setup shows a large head and shoulders pattern that's right on the verge of breaking down that $270 neckline. Same with Google, which broke below the 2,500 key level of support last week. Snapchat's earnings last week also showed some weakness in digital ads as well. and Amazon, which could take a hit this quarter from extra fuel costs and labor. There was also a lot of clever accounting from their Q4 results, where their investment in Rivian showed a huge profit. How are they now going to show the Rivian stock price loss in their earnings this quarter? Certainly some questions there which could end up affecting the stock after earnings. But overall, because these companies make up such a massive portion of the major indices, if these mega caps report disappointing numbers this week, that could cause a lot of pain in the broad market, potentially send us on a flush down. So be prepared for anything overall this week. But on the bright side, if we do see these mega cap companies report disappointing numbers and they end up dropping, that could signal the last flush / the last leg down of this market crash. Now, why is that? Well, during market crashes, corrections, usually the highest quality companies are the last to fall. That kind of signals the last capitulation phase where everybody just feels like there's no relief in sight. Earnings are bad, the economy is bad. And once investors / traders kind of end up losing that buy the dip mentality overall, that can signal the final washout. Buyers come in when things look the most bleak. That's when things end up bottoming, and we could go up fast from there. But this could signal the start of the leg down. At the same time though, these are some amazing companies. They almost always beat earnings. Who's to say that they don't beat earnings again this quarter? That is a scenario that could easily happen. So just be ready for anything. I'm not advocating buying puts on these companies or anything. Just be prepared for a big flush down in the indexes, which will obviously affect any other things in the market. If these mega cap companies do report disappointing numbers, which is a possibility in my opinion, like I've been talking about, but of course it's not a guarantee. So be ready for anything to happen in the market this week, and don't be shocked by any numbers that are reported. Now, one big upcoming trade opportunity is the next FOMC meeting that is coming up on May 4th. So in the scenario that the market sells off leading into this May 4th date, maybe we see those mega cap companies miss their numbers and then sell off, resulting in a market flush down. If we end up selling off into that May 4th date, which there's usually a lot of fear leading to these Fed meetings as well, that could likely set us up for a big bounce back rally after the meeting. Just like we saw at the last FOMC meeting on March 16th, that marked the start of the huge market rally we saw into the end of March. Especially if we sell off once again into the May 4th catalyst, that would likely set the market up for another big rally and create a lot of swing trade opportunities to buy the dip and ride the trend back up right before this date, which would be the last fear catalyst for a while. With these catalysts that cause a lot of fear, instead of it being like a sell the news situation that you would with a hype catalyst, with all this fear going into these FOMC meetings, any other fear catalysts that the market is worried about, when that date happens and the news hits, that usually turns into a buy the news situation. So people buy the dip because there's no more fear catalyst for a while, got that over with, and then you can start the next rally to the upside. In my opinion, that had a great chance to happen. The risk here is though, in the small chance that the Fed does raise rates by 75 basis points, that could obviously cause a lot of pain for the market. I believe right now that the market is pricing in about a 3% chance for that to happen. So it seems close to a certainty that we'll get a 50 basis point hike. And in that scenario, in my opinion, because the market already expects that, we will rally hard off of that news at the FOMC meeting. So that is something I'm personally preparing for as a swing trade, to buy the dip right before that date and ride the trend back up for the next rally. So I hope you guys enjoyed the video, provided some value to you as well. If so, make sure to hit that like button and subscribe button. Helps me out a ton, and I would greatly appreciate that. For anyone interested in joining the private Discord chat, that's the first link down in the description. You get alerts every time I personally buy or sell any stock, answer any questions you have, nightly watch lists every single night for the trade opportunities the next day, and market outlook, and more. So that's the first link down in the description for anybody interested. Thanks so much for watching all the way through, guys. Really do appreciate it. I'll catch you all next time. Stay safe this earnings season, and peace out.